Thank you for joining us at XM.com for the special report. Equity markets started the new year on a strong note, but it's questionable whether this optimism will last. I'm Cristina Marujos. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, the quarter four earnings season has kicked off last Friday, and the consensus is that earnings are expected to decline on a yearly basis. Do you think earnings are starting to reflect signs of a recession?
Hello, Christina. I think it's a little bit too early for that. So the leading economic indicators, we got some business surveys lately, and those are painting a pretty gloomy picture about what comes next in the US economy. So specifically, new business orders are falling very sharply. Now, usually that signals softer economic growth or even a recession a few quarters later. So we are getting a lot of economic data that are saying the economy is doing badly. Now, the question is, will this be reflected in this earnings season, or is it too early? I'm in the camp that says it's a little bit too early. Maybe it's a story for the next quarter and the next earnings season. So let's take a step back. Earnings for the S&P 500 are expected to decline, specifically by 4% from last year. And an important note there is, if you take out the energy sector, so remember the energy sector is still earning super normal profits because of the whole energy crisis. If you take out the energy sector, earnings are expected to decline by 8%, not 4%. So that, I think, paints a more realistic picture of what's happening overall with these companies. So what's the play for this earnings season? The market is expecting some weak results, but expectations have also been set so low that it might be relatively easy for a lot of these companies to beat those gloomy expectations. That's what we saw the last couple of earnings seasons. There was a lot of pessimism among investors, but the earnings forecasts were so low that a lot of companies managed to jump over them. So I think something similar might play out this earnings season, but the catch is the following. I think that the risks surrounding the market are asymmetric and tilted to the downside. And by that I mean, I believe that if some company reports solid earnings, the stock might rise, but not dramatically. Whereas if a company reports disappointing earnings, that might lead to much more severe selling. And the logic behind that is valuations. Valuations are still really expensive. Valuations for the stock market are still consistent with a soft economic landing. That's not what the leading economic indicators are telling us. The leading economic indicators are telling us that it's going to be a harsh economic environment. So when you have the stock market being priced for perfection almost, when you get the good news, that's already expected. Whereas if you get any bad news, that's the surprise, and that can lead to a more severe reaction, I believe.
So bearing all of this in mind, Marios, what is the outlook for stock markets? Does the risk reward seem attractive here?
Not particularly, Christina. So let's go back to valuations for a second. The S&P 500 is trading at 17 times this year's expected earnings. That's quite expensive. If you go back to previous bear markets, we bottomed with a multiple closer to 13 or 14x. So there's still some room for valuations to adjust, and that's before even considering the risk that earnings might be downgraded during the course of the year. We've seen analyst estimates for earnings come down a little bit lately, but not much. I suspect that we are still in the early stages of this process. So there isn't much room for error. The stock market is priced as if the economy is going to do pretty well, but the leading indicators are telling us that we are likely to face a deteriorating economy during the year. That's not priced in at the moment. Therefore, I don't particularly like the risk to reward profile here.
Marios, thanks so much. This was a special report here at XM.com.